Okay, before we get started here, let's talk about where we are in the context of the whole course. In episode 1, we learned some stock trading terms. In episode 2, I taught you how to set up your online trading. So now in this episode, episode 3, we're going to start learning how to save our money. Now we've talked about direct trading in previous episodes. Now if you're just starting from scratch and don't have any money saved, it might be a good idea to look at some other investments, and that's what we're going to explore in this episode. Now in our next episode, we're going to look at some of the best traders on Wall Street, and actually some of their lessons learned over the years. Also, stocks don't trade in a straight line. They go up and down, and I'm going to teach you some of the best times to buy stocks in certain industries and just in general. Finally, by episode 6, we're going to put all this information together and you're going to develop your own trading style. My job at the end of this course is not to tell you what to buy. It's to help you make really good informed decisions and you can make your own choices. Your choices in buying stocks will reflect your interests and your tolerance for risk. So finally in episode 7, we're going to put the whole course together and we're going to talk about what your stock portfolio might look like. Let's back up a bit. So first we have to start putting money away so we can actually buy some good stocks and make some good stock choices. So that's the subject matter of this episode. Is this you? You work in the paint store, get paid regularly, and then blow all your money at the disco. You say to yourself, I really want to be successful. I'm getting older too, and I have to make some changes in my life. Okay, my goals are to get wealthy. That should solve most of my problems. Yeah, I can work when I want, travel, do awesome things, and retire early. I can even set up my family for success. What are my options to get there? I know, I'm just going to buy a lottery ticket and eventually I'll be rich. Well, actually, you have a better chance of being struck by lightning than by winning big in the lottery. Okay, maybe there's some easy way to make money. After all, there are so many options. Well, everyone wants to make money by selling his swampland in Florida, so success is uncertain and rare. Okay, let's be logical. I can just work really hard, my salary will grow, and eventually I'll be rich. Well, the reality is you can make $200,000 and still spend everything. So attaining wealth is very elusive for most people. Okay, let's consider making money through regular savings and letting it grow through the stock market. I'll tell you what, if you follow this plan, you can invest as little as $50 a month. You'll be wealthy 100% of the time. Those are pretty good odds. You can even follow this strategy and still try anything you want on the side. At least this can be your backup plan, whatever happens. You think we would have learned a better way to make money in the last 4,000 years? Many of us still live paycheck to paycheck and grumble about Monday morning as we make our way to work every week. This seems normal now, but 4,000 years ago, the Babylonians discovered that this was entirely a life choice and a totally unnecessary way to live. So I'm dedicating this episode to George S. Clason, who wrote a book in 1926 based on Babylonian wisdom, teaching everyone that they can become wealthy. So there's no reason to complain about having a minimum wage job and working like a slave until you retire. You are not a slave to your money. Instead, make money your slave. George S. Clason is in fact credited for being the first person to say, pay yourself first. This concept was repeated in the 1989 book, The Wealthy Barber. In it, author David Chilton examines the life of a barber who saved his money regularly and was looking forward to a wealthy retirement lifestyle. So strap in, and I'll show you how to invest and grow your savings. 4,000 years ago, the Babylonians did it, and they didn't have a great moneymaker like the stock market of today. Okay, this is where I begin with my wealthy barber speech. Using this method, you can double your money in 3 to 5 years. So if you have saved, say, $5,000, you can end up with $10,000 in about 3 to 5 years. What if you have saved $500,000? Well, then you'd be an instant millionaire in 3 to 5 years. This is why you must be patient and consistent and forget about short-term satisfaction. Okay, so how do you get started? So you may even be in a situation where you have to live from paycheck to paycheck or have no savings. Somehow you seem to go out and spend your whole paycheck even before you've saved any money.
Okay, so in this episode,
First of all, when you get paid bi-weekly, you pay yourself first. Before spending any money on shopping or bills, you pay yourself first. Although the wealthy barber suggests contributing 10% of your income, it can be as little as $50 per paycheck. Second, you go to your bank's financial advisor and tell them you want to put this money away on a regular basis every time you get paid. So on payday, you have money transferred to this account and you can't reach it. This account should not be available through your ATM. As far as you're concerned, it's not for drawing when you need the money. This is for saving and putting away for your retirement or for your children.
fourthly, the greatest builder of wealth is time.
So if you start saving when you're 20 to 25, you can still be a millionaire in 20 to 25 years, even by putting $50 away. The principle is simple. The money you earn will be your initial investment, plus the interest on your savings, plus possibly some dividends.
Finally, we'll look at designing a financial plan. Okay, now dividends.
Although I've mentioned dividends in episode 2, we'll need to have a better understanding of this term before we proceed. Okay, dividends. Now, when the boards of some companies meet, they decide to pay their stockholders a certain amount of money based on the profits they've earned on their own company, typically each financial quarter. This amount is then divided by the number of shares to come up with a dividend yield, which is then expressed as a percentage of the total stock price. So if the dividend yield works out to 2%, this quarter you'll typically be paid 2% divided by 4 quarters, or 0.5%. That's 0.005 of the stock price times the number of shares as cash in your bank account. So if the value of the stock is about $400 a share and you own 20 shares, that comes out to about $8,000. Times 0.05, your dividend will be about $40. Now that's free money in addition to the amount of the stock has grown. Now it's also noteworthy that young, fast-growing companies generally do not give dividends. Dividends are generally reserved for larger, blue-chip type companies. An exception is Amazon. Now Amazon does not offer a dividend on its stock, which is strange because it's such a large company, but it is growing fast. So it puts a lot of that money back into the company. Okay, now let's resume our discussion about setting up your savings account. I think this is the simplest way to proceed, so I'm going to go through it step by step. So first of all, in setting up your savings account, you should use the untaxed accounts that I described in episode 2 if possible. Please review this information if you need to. Now the second step is to choose an initial investment. Your bank's financial advisor can assist you with this decision. And then step number 3, move to direct trading if you really want to pursue this or decide that you want to move when it's prudent for you. Number 4, start thinking about your investment and have a plan or a strategy when you get to that point. Okay, let's talk about step 1, setting up your savings account. Let's assume you have no savings and you want to start investing as soon as you can. Ask your bank's financial advisor to set up a retirement savings account. If you're in Canada, you can begin with a tax-free savings account. Tell your financial advisor that each time you get paid, you want to move that money into the new mutual fund which you've identified at your bank. Now you can put any amount in, but you can put as little as $50 in. Please ensure that this money is not accessible through your ATM. So let's look as we move more into stock trading. If you follow my course and follow my trading advice, I would expect direct traders to make as much as plus or minus 20% per year, that's quite a bit. You can see by earnings, even at 18% per year, you can approach $1 million in 20 years. Especially as your investments grow, your returns just keep accelerating and accelerating. Imagine if you had a baby and put away $50 per paycheck. They could become a millionaire in their 20s. How would that change the life of your family? Imagine the next 20 years. Saving would be off the charts. Don't you wish someone did that for you when you were a baby? Okay, let's talk about choosing your initial investment. So At the very beginning, when you get started, you want to spread your risk evenly. So contribute your money to a mutual fund offered at your bank. Please review episode 1 if you need more information. So each bank will probably have an assortment of various mutual funds. But what should you choose? Well, the financial engine that drives the economy is technology. In episode 1, I discussed the various stock market indices. Now, the mutual funds that outperform the Dow Jones and the S&P 500 index have been associated with the NASDAQ, which has a large percentage of its companies in the technology sector. So choose a mutual fund that includes a large array of these companies. So the top 10 companies in my mutual fund when I initially got started varied across the board, but here are some of the companies. Now, the mixture in my particular mutual fund was Amazon, Microsoft, Apple, Alphabet, which is also called Google, Visa, Danaher Corporation, which I think is a medical supplier, United Health Group, Johnson & Johnson, Cisco Systems, and last in the top 10 is ServiceNow Inc., which is a cloud company. I'll explain a little bit more about cloud companies when we talk about technology a little bit more. So each bank will publish a list of their mutual funds and how they perform over various years. Although the returns are generally over 10%, you can find funds that have performed over 12% a year for the past 10 years, even despite the current recession caused by the COVID-19 epidemic. Now, moving to direct trading. So let's assume your savings now exceed $10,000. Now that may take 3-4 years to exceed that amount, but once you get there, you have to decide, do you want to move to direct trading? Or otherwise you can leave your investment in a fast-growing mutual fund. Leaving your money in a fast-growing mutual fund is no crime, since savings can grow quickly if they're in a great fund like the one that I just mentioned. You know, maybe you like this mutual fund and you just want to use the George Foreman grill approach and set it and forget it for now. You can always come back and move to direct trading when you're more adventurous. Just be aware that your bank is also managing the stocks in the mutual fund, and you have virtually no control over the mixture over time. And these stocks may change. So when you move to direct trading, you'll get more control of your portfolio. You'll be able to say, I want a certain percentage of this stock or that stock, and it gives you much more freedom. Personally, when I reached the $10,000 limit, I discovered that my bank would no longer charge an annual fee
For the
direct trading application. So I made the decision to make the jump to direct trading, since I got the application for free anyway. Now, once you make the decision to move to direct trading, it is essential to understand more details of stock trading. In my next episode, episode 4, I'll be exploring the habits of the best and former traders on Wall Street, and consequently, some of the wealthiest people in the world. In episode 5, you'll discover that there are better times to trade for certain individual stocks. Then in episode 6, I will help you determine the mixture of investments in your personal trading portfolio. What percentages are you going to hold in gold, mutual funds, technology stocks, or companies that have been growing at amazingly fast rates, like Amazon, Spotify, Zoom Video, and Tesla? So please subscribe to my channel and continue on this journey with me. There's a lot of good content ahead. For more advanced savers, however, there may be other things that you might consider. So let's go through these. So pay yourself first account, that is must do. That's what this course is about. This is what you should pursue. Now, the second thing you might do is you might do a similar thing for your children. So set up a savings account for your children. You may decide that you want to set up a rainy day fund. So if you have any emergencies, you'll have some extra money. If you have debt, you have to, I'm not going to dwell on it, but you have to make a plan to start paying it off. So let's quickly talk about each one of these types of accounts. So the first account is the pay yourself account. It's like the oxygen mask on a plane. Put your own mask on, and then you can help others. The second part is setting up a savings plan for your children. Alternatively, you might consider an education savings plan. So I'm not going to go into details, but in the US you can start a 526 plan. In Canada, the equivalent is an RESP, or Registered Education Savings Plan. And any relative can actually contribute to this plan. Once set up, the federal government will match money up to a certain amount with a grant. Okay, so let's briefly talk about the rainy day fund. Now, if you have the capability and you want to put a little money away for a rainy day fund, who knows, you could have an unexpected job loss or have an accident or incur some financial expenses you don't expect. So most financial planners feel that it's good to have at least 3 to 6 months of pay tucked away in the event of an emergency. Okay, now finally, paying off your debt. Now, I know everyone knows what that's about, and I'm not going to pester you with this. Let me give you an example of something you might consider. Say my balance is on my credit card is $5,000, and it stays pretty much the same for 5 years. At 20% interest, that means I will pay a full $5,000 throughout the 5 years. Ouch! You know, that's painful. That's a lot of money. Now, alternatively, if I owned $5,000 in Visa or MasterCard stock, these two stocks have grown 3.5 times over the last 5 years. So I would make $5,000 times 3.5 in 5 years plus dividends, or $16,500 plus dividends. You know, you owe to yourself to turn things around in your life. So stay tuned, there's lots more good content to come. I'll talk to you later. Bye for now.